In 1950, there were 16 American workers for every one retiree collecting Social Security, a ratio that made the arithmetic of retirement look almost effortless. A broad, growing base of contributions supporting a relatively small group of beneficiaries. In an era of high fertility, strong productivity growth, and expanding populations across the developed world, and policymakers in Washington, Berlin, Tokyo, London, and Paris convinced themselves that the post-war social contract worked for 40 years. Receive a guaranteed pension for the rest of your life was not just sustainable, but permanent. For decades, this illusion of permanence shaped how governments, unions, and corporations designed retirement promises, defined benefit pensions that guaranteed a fixed payout, indexed to wages or inflation, financed on a pay-as-you-go basis where current workers' contributions would fund today's retirees, on the assumption that every generation would be larger, richer, and more productive than the last, and that demographic momentum would always push upward. It was a simple, comforting story. As long as the economy grew and populations expanded, there would always be enough to pay what had been promised. But behind the reassuring language of guaranteed benefits and Social Security, an uncomfortable mathematical reality was slowly forming, one that would only become visible once the demographic winds shifted direction. These systems were not fully funded savings plans, but intergenerational transfer machines, and their solvency depended entirely on the ratio between contributors and beneficiaries, on fertility rates, life expectancy, and wage growth remaining within a narrow, optimistic band that post-war planners had treated as a given, rather than a fragile anomaly in economic history. As the 20th century progressed, two silent revolutions began rewriting that equation. First, life expectancy climbed steadily upward, turning what had historically been a brief period of retirement into a multi-decade phase of life, which dramatically increased the cost of a promised pension annuity. Second, fertility rates collapsed across the developed world, falling below the replacement level of 2.1 children per woman in countries from Italy to Japan, Germany to South Korea, shrinking the future base of contributors and reversing the demographic pyramid that these pension systems were built upon. By the early 21st century, the result was a structural imbalance that could no longer be dismissed as a temporary budget issue. Hundreds of public and corporate pension funds across the United States, Europe, and parts of Asia were now carrying enormous unfunded liabilities obligations to future retirees that far exceeded the assets set aside to pay them, contributing to what analysts began to describe as a global retirement crisis, with estimates of total shortfalls running into the tens of trillions of dollars, a figure that continues to rise as populations age and wage growth stagnates. What had started as a noble promise to protect citizens from poverty and old age had quietly transformed into one of the largest off-balance sheet liabilities in modern history, a slow-moving financial time bomb embedded deep within government accounts, municipal balance sheets, and corporate ledgers whose eventual detonation would not come with the noise of a market crash, but with something far more politically explosive, the realization by millions of workers and retirees that the numbers simply do not add up, and that the pensions they were told were guaranteed are, in fact, contingent on demographic assumptions that no longer exist. By the time economists began putting hard numbers on the global retirement problem, the picture was already disturbing. International organizations and consulting firms were estimating a retirement savings gap between what had been promised and what had actually been saved well above $30 trillion, a figure that grows each year as populations age, interest rates fluctuate, and political systems hesitate to confront a problem that is, by design, invisible in the short term, but devastating in the long run. At the core of this crisis is a simple, brutal equation. A pension system, whether public or corporate, is essentially a long-lived promise to pay a stream of benefits in the future. To honor that promise, you either need sufficient assets invested today earning a realistic rate of return, or a sufficiently large and growing tax base tomorrow willing to be taxed heavily enough to cover the shortfall. For decades, many funds and governments chose a path in between. They set aside some assets, but not enough, and then assumed that high long-term investment returns, often 7 to 8% per year, would make the numbers work, even as demographics and productivity growth began to undermine those optimistic projections. Actuaries, the quiet mathematicians of this story, calculate something called the funded ratio, the present value of a pension fund's assets divided by the present value of its promised future liabilities. A funded ratio of 100% means, in theory, that the plan has exactly enough money, given assumed returns and longevity estimates, to pay every benefit it has promised. But as asset returns underperformed lofty assumptions as lifespans continued to stretch, and as benefit formulas remained politically untouchable, many large pension systems drifted downward into the 70s, 60s, or even lower, effectively admitting that for every dollar promised, only a fraction had actually been secured. To make those ratios look less alarming on paper, many funds leaned on a powerful accounting lever, the discount rate, the assumed rate at which future liabilities are brought back into today's dollars. The higher the discount rate, the smaller those future obligations appear in present value terms, and the healthier the plan looks on its financial statements. In practice, this meant that some pension systems could claim to be mostly funded, simply by assuming that markets would deliver high, steady returns indefinitely, an assumption that worked as long as interest rates were. Low asset prices were rising, and no one asked what would happen in a world of lower growth, higher volatility, or prolonged downturns. But demography does not negotiate with accounting, and this is where the numbers become unforgiving. In country after country, the dependency ratio, the number of working-age adults relative to retirees, is moving in the wrong direction, reducing the flow of contributions, just as benefit outflows are accelerating. In Japan, Italy, and Germany, aging populations and low fertility mean that a shrinking workforce must support an expanding cohort of the elderly. In the United States and United Kingdom, generous public sector pension promises at the state and municipal level, combined with underfunding and optimistic return assumptions, have created vast hidden debts that do not appear in headline government debt figures, but are just as real when the time comes to pay them. In this context, the phrase mathematically insolvent is not rhetorical. It describes a situation in which, given current contribution rates, benefit formulas, demographic trends, and realistic return assumptions, the system cannot meet its obligations without either drastic cuts, dramatic tax increases, or financial repression that silently transfers wealth from savers to debtors. The crisis is not a sudden collapse, but a slow convergence of trend lines. Promises rising on one side of the graph, resources failing to keep up on the other, with the $31 trillion retirement crisis functioning less as a single event, and more as a description of the widening chasm between what societies have said they will do for their elderly and what their economies can actually support. The first visible cracks in this system did not appear in spreadsheets or actuarial reports, but in the political and social fabric of real places that discovered, often abruptly, that their retirement promises could not be honored in full. In the early 2000s, as equity markets reeled from the dot-com bust, several U.S. state and municipal pension plans saw their funding ratios plunge, exposing how dependent they had become on ever-rising asset prices. Then, after the global financial crisis of 2008, when markets crashed and interest rates fell toward zero, the gap between pension assets and liabilities began to look less like a cyclical problem and more like a structural one that no recovery could fully repair. In cities like Detroit, the story turned into a cautionary tale. Years of industrial decline, population loss, and shrinking tax revenues had weakened the city's balance sheet. But it was the weight of unfunded pension and retiree healthcare obligations that helped push Detroit into what was, at the time, the largest municipal Bankruptcy in American history. During the restructuring, retired police officers, firefighters, and city workers, people who had been told for decades that their pensions were legally and morally sacrosanct, were forced to accept cuts to their benefits, a visceral demonstration that, when the money is gone, even guaranteed promises can be rewritten in court. Across the Atlantic, entire nations became case studies in how demographic and fiscal pressures collide. In Greece, the sovereign debt crisis of the early 2010s exposed a pension system that was both generous and fragile, with relatively low retirement ages and high replacement rates funded by a weak, narrow tax base. When the country's finances collapsed, one of the first demands from international creditors was pension reform. Higher retirement ages, lower benefits, tighter eligibility rules. The images of mass protests in Athens, pensioners marching in the streets, pharmacies, and public offices shuttered, captured a deeper reality. When a state runs out of fiscal space, it is the long-term promises to its own citizens that become bargaining chips in negotiations with bondholders and international institutions. In Japan, the world's oldest major society, the crisis has emerged less as a dramatic shock and more as a slow, relentless squeeze. With one of the highest life expectancies on Earth and one of the lowest fertility rates, Japan's demographic pyramid has inverted, placing enormous pressure on its pay-as-you-go public pension system. Successive governments have responded by gradually raising the retirement age, adjusting benefit formulas, and encouraging private savings, but these measures have not altered the core dynamic. Fewer workers supporting more retirees. With public debt climbing above twice the size of the economy and the central bank holding interest rates near zero to keep the system from buckling under its own obligations. These are not isolated stories. They are early warning signals of a broader pattern. From Italian workers facing proposals to extend contribution years, to French citizens protesting attempts to raise the legal retirement age, to American teachers and public employees discovering that their pension funds are far less secure than they believed. The same message keeps resurfacing. The arithmetic of aging societies is beginning to overpower the political narratives that once framed retirement as an unshakable right, and every attempt to adjust the system through cuts, tax hikes, or financial engineering meets the resistance of millions who built their lives around promises now revealed to be contingent, fragile, and in some cases, impossible to keep. As the implications of aging populations and underfunded pensions became harder to ignore, governments and pension managers did not immediately cut benefits or raise taxes. Instead, they reached first for the quieter, more complex tools that could postpone conflict while preserving the appearance of solvency. Instruments that operated not on the streets, but in bond markets. Central bank balance sheets, and technical committees far removed from public view. For central banks, the era after the 2008 financial crisis and again after the 2020 pandemic became defined by ultra-low interest rates and large-scale asset purchases policies justified as necessary to stabilize economies and protect jobs, but which also had a powerful side effect. They kept government borrowing costs artificially low, allowing states to roll over rising debts, including implicit pension debts, without triggering immediate fiscal crises. For pension funds, however, this same environment created a paradox. The safer assets they had long relied upon, government bonds and high-grade credit, now yielded far less than the 7 to 8% return assumptions embedded in their actuarial models, forcing them to search for yield in riskier places. This search for yield reshaped portfolios. Public and corporate pension funds poured money into private equity infrastructure, real estate, and complex derivative strategies designed to match long-dated liabilities with asset cash flows, a trend that produced impressive returns in good years, but left funds increasingly exposed to market volatility and liquidity risk. In the United Kingdom, this dynamic surfaced dramatically in 2022, when liability-driven investment strategies used by many pension schemes, Leverage bets built on the assumption of stable bond markets were suddenly stressed by a spike in yields, forcing emergency interventions by the Bank of England to prevent a broader collapse. The message beneath the technical language was simple. In trying to make impossible promises appear affordable, the system had quietly multiplied its own fragility. Politicians, facing the electoral consequences of confronting these problems head-on, often chose a slower, more incremental path. Retirement ages were nudged upward by a year or two. Benefit indexation was modified in ways that would only fully reveal their impact decades later. Younger cohorts were shifted into defined contribution systems where investment risk was borne by individuals rather than pooled in collective funds. Official projections continued to rely on optimistic assumptions about productivity growth, immigration flows, and future market returns, even as real-world data pointed to slower growth, cautious households, and political resistance to large-scale population inflows. At the same time, a subtler mechanism of adjustment began to operate through inflation. When price levels rise faster than benefits are adjusted, or when interest rates are held below the rate of inflation, the real value of promised payouts erodes quietly over time, a form of financial repression that transfers resources from savers and fixed-income recipients to heavily indebted states. For retirees living on fixed pensions, this shows up as a gradual squeeze in purchasing power, the grocery bill that grows faster than the benefit check, the healthcare costs that outpace cost of living adjustments, yet in aggregate, it functions as a kind of stealth default, reducing the burden of future obligations without ever formally announcing that a promise has been broken. Through all of this, the narrative presented to the public remained relatively calm. Reforms were technical, adjustments were necessary for sustainability, and the system, while under pressure, was fundamentally sound. But beneath that language lay a stark reality. Every year of delay, every choice to rely on optimistic assumptions rather than recalibrate expectations, deepened the eventual adjustment that would be required, shifting costs forward in time and downward in age. From current retirees to the younger workers, who would inherit a system more strained, more indebted, and less capable of delivering what their parents and grandparents had taken for granted. By the mid-2020s, the phrase $31 trillion retirement crisis had become a kind of shorthand, a headline-friendly number that tried to capture something much deeper than a funding gap on a balance sheet. It described the cumulative result of decades of demographic drift, political avoidance, and financial engineering, a global structure of promises built for a world that no longer exists yet, still defining the lives and expectations of billions of people who have organized their futures around it. For the individual worker in Chicago, Milan, Osaka, or São Paulo, the crisis rarely announces itself with a single dramatic event. Instead, it appears as a series of subtle shifts. A notice that the retirement age has been raised. A letter from a corporate HR department explaining that defined benefit plans are closed to new entrants. A statement showing investment performance that falls short of what will be needed to maintain a desired standard of living. A news story about a local government debating cuts to cost of living adjustments. Each fragment can be rationalized as minor, manageable, part of necessary reforms, yet together, they mark a transition from a world of guaranteed security to one of contingent, probabilistic outcomes. At the systemic level, the options are brutally simple, and none of them are painless. Benefits can be cut directly, either openly through legislation or indirectly through formulas that adjust payouts more slowly than inflation. Taxes and social contributions can be raised on younger and working-age populations, dampening growth and fueling intergenerational resentment. Immigration can be expanded in an attempt to broaden the contributor base, triggering political backlash and social strain. Productivity can be pushed upward through technology and automation, which may raise aggregate output, but can also disrupt labor markets and wage trajectories, complicating the same contribution streams on which pension systems rely. Some countries will navigate this transition more smoothly than others, leveraging stronger institutions, deeper capital markets, and more flexible political cultures to gradually recalibrate expectations and spread the costs across generations. Others, with weaker governance, narrower tax bases, or more rigid labor markets, may experience sharper breaks, sudden fiscal crises, abrupt benefit cuts, or inflationary spirals that erode the value of savings in a matter of years. In both cases, the underlying dynamic is the same. The gap between what was promised and what can be delivered is being closed, not by clever accounting or higher yielding assets, but by real changes in who bears the cost. The unsettling truth behind the title, the $31 trillion retirement crisis no one can stop, is not that policymakers are powerless in the face of mathematics, but that the parameters of the problem are already largely set by past decisions, demographic momentum, and the irreversible aging of populations. Even bold reforms enacted today cannot retroactively increase birth rates in the 1980s or 1990s, cannot shorten lifespans already extended by medical progress, cannot undo decades of underfunding with a single law or budget cycle. They can only redistribute, resequence, and reframe the adjustment that must occur. What remains within human control is not whether the adjustment happens, but how it is managed, transparently or opaquely, equitably or regressively, through open political debate or through opaque mechanisms like inflation and financial repression. The retirement crisis is, in this sense, not just a financial story, but a moral and political one, a test of whether societies can confront uncomfortable arithmetic without turning generations against each other, and whether the end of one model of retirement can become the starting point for a new, more realistic contract between citizens and the states and institutions that claim to secure their futures.